We were talking about the fact loans
Yes.
are critical to this process as a segue to Michael. Yes.
Thank you. Thank you, Carol. I always enjoy listening to you. One of the things that we're looking at, and we're talking about loans and just overall financing, is how to really bulletproof yourself and your financing. We need to take a look at what we're doing in terms of the short term versus the long term. We want to make sure that we are affordable not only now, but also in the future as well. I think what Carol said in terms of talking about single-digit appreciation, we can kind of count on that. If we get some double-digit appreciation, that's great, but we need to make sure that we're doing the financing correctly. We have to take a look at where interest rates are today. We have to take a look and see the other terms and conditions that people are looking at when they're looking at purchasing a home and using financing techniques. And they have to make sure that they're really addressing financial correctness versus cash flow. And some of those things when we were talking about off the air was looking at cash flow and how important that is to the people in the San Mateo and the Bay Area versus being financially correct.
Mm-hmm. Well, the 100% loans, all of the different types of loans that are out there, you talk about the neg am, you talk about, again, the 100% financing, you talk about the low FICO scores, the high FICO scores. What should the consumers be looking at? What can eat into their accumulation of wealth, so to speak, with regards to loans?
Well, I think as we're looking at some of the things that buyers should be taking a look at this point is really looking at when they're starting to address looking at buying a home, should they be pre-approved? They should really be factoring in, again, interest rates, where they are now and where they're going in the future. Also, again, just going back to what options are available. Some of the situations that people have got themselves into because they're really trying to get into a property any way that they can is taking loans that have these short-term options, but they're not paying attention to what's going to happen in the long term. And long term could be 6 months, it could be a year, it could be 2 years or 3 years out. And I think that's really important. People that own property now really have to be looking at what refinancing options are. I think there's something like $1 trillion worth of loans that people have that are on this adjustable that are going to reset this year. One of the things we were looking at is when we were talking just generally about rates and that 30-year fixed kind of benchmark, we were looking at where adjustable rates are now, and the Fed's been raising short-term interest rates, but when we talk to clients who are saying, well, I'm only thinking about being in the property 3 to 5 years, I'd like a loan that kind of matches that. What lenders don't tell them is if that loan was an adjustable today, where would that rate be? And that goes back to that financial correctness, why we're seeing 30-year fixed is really the financially correct answer.
You know, Michael, you and I throw around these terms pre-approved versus pre-qualified. Would you just basically tell our listeners and our audience what that means and why one is so much better than the other?
Well, in real estate agents in general need to be very, very careful because when they're thinking about talking to a client or putting a client in their car and driving them around or actually writing an offer, pre-qualified is kind of sitting there playing with a calculator and a piece of paper and doing kind of what-if scenarios. That's pre-qualification. That doesn't really hold any water. When the next step is actually pre-approval. Pre-approval is actually credit and income, and you're verifying that. You're looking at a scenario of a range of where they think they might want to be based on what kind of down payment they want to put. And that really gives them, they need to know what their limits are. Because a lot of times when I'm dealing with a client, we sit down and we've established this limit. Maybe it's $900,000, and they're really saying, I want to go a little bit further. That little bit further, based on credit and income, kind of forces them a little bit more into loans that may not be as suitable, being respectful to the long term. And that's the thing that when I tell somebody that this is really where they belong, that's kind of really where they belong.
So you've got refis coming in. These people are coming up. They're going to get, so we've got to address that component. We've addressed the fact you want to purchase and that there are a number. The neg ams you've got to be careful of. That'll eat up all your profit, especially if we flatten there goes your wealth.
Right.
Then, but the refis, what should people be looking for, Michael, if indeed they've got to come and go get something different than what they are going to have readjusted on them in the next couple of years?
Well, I think one thing they need to do is make sure that they're paying attention. I mean, obviously, you've got your, for the refinance world, you have your statement. Take a look at it. A lot of people tend to have their minimum monthly payment automatically taken out of their checking account, and they never look at the statement. And they don't even really pay attention to that. But when you're looking at those rates, the other thing is taking a look and seeing if there is any other financing on the house. A lot of people have equity lines that were used to consolidate consumer debt or to do home improvements or things like that. Those, for the most part, are variable rate loans. So they have that volatility up and down. They're usually tied towards some type of deposit index, and that deposit index is short term, and therefore those rates are a little higher than kind of what they would, you'd like to do if you were looking at doing some refinancing.
Now that we